Welcome back. I have an exciting pick I'll cover with you in a second, but this is another episode of Follow the Money. My name is Joshua Belanger, and we're going to talk about the perfect short-term stock replacement that we could put on today and works ideally with any account size. But it's a good outline to understand why options are so versatile and how to use them instead of stock to reduce your overall risk. So today we're going to look exactly at that, and we're going to follow the money. So we're going to look at Pitney Bowes today. PBI, that's Paul, Bravo, Ivan. And if you see here, if we take some fun stabs at technical analysis, you can make the case that this is a head and shoulders here, whatever the case be. We had a big sell-off here after earnings that went and hit a high of $7.70 and crashed all the way to about $5.20. So a stock under $10, we're going to see a lot of volatility. Even stocks under $20, you're going to see a lot of volatility. So today we get a pop-up higher today. And the reason of this move higher is what we saw some stock being sold in replacement for options that were deeper in the money. So let's take a look here at the option chain. So if we take a look here at some of the activity, we'll take a look here at the calls. Calls traded 140,000 calls to 23,000 puts. So for a $6 stock, very active in a stock that traded 21 million shares today. So it's a pretty busy day in this specific underlying. And that's why it's important to have systems. You have to have an electronic eye to be able to spot this kind of activity or activity in all the names that are traded. There's millions of contracts traded today, and there's 2,000 optionable stocks. So it's a lot of scanning that you would have to do manually if you typed in all this. So that's the best thing about electronic eyes, algorithms, whatever you want to name them. And that's where we have ours to follow the money. Today we're looking at the February contract. And if you notice here, the February contract traded 27,000 calls. Whew! That's a lot of calls traded right there. Sticks out like a sore thumb. And they're coming in here earlier at 85 cents. So that was when shares traded at $5.33. Since then, it was up $1. So if we take the equivalent of that move, that would have been about a 70 delta. Well, actually about a 63 delta. So these were in the money when they bought them. They're 63. They move now up to 79. So when someone comes in the money, and we see big volume, this is a contract block that traded at one time, that is a strong indication that they were getting out of shares and getting into options that were in the money. Now, the benefit of that is that when they bought these, it was 85 cents. So instead of tying up all the capital that it were required at that time of $5.33 per share, they bought the options that expired 52 days from now, and those only cost them at that time $85 per contract. 85 cents times 100, you get the equation there. So they came in and bought a big chunk of those, and that's why it's a good indication that this was a stock replacement strategy. Shares are at that time were $5.33. You take that $5.33 minus 85 cents paid, puts us around this area here. So if you were concerned about in the next 52 days about possible more volatility or this breaking down more, and you wanted to hedge that risk, you would look to play it with the calls that they went and played into. The interesting thing is after that activity, we saw more activity come into the 6 strike here, and someone may look, and you should look at both sides and see what's going on here, but someone may say, hey Josh, well, what's going on with that, the puts here? Well, this was closing and rolled into here. So this would actually indicate to me that they're rolling that position. It was a hedge, so this could be a hedge on that same position. I didn't really look specifically at the times, but just putting the puzzle together, that's what I have to assume. I don't think it's the bullish case or the amount of money on the call side is much more extreme than it is on the put side here. So being that they rolled this position from January to February indicates to me that that's probably some kind of hedge, and that hedge being on this position here where they're looking to play it higher. So again, we had this volume here in January as well, and again, it's indicative of some short-term activity that happened here. It was up $1 here, but then when we look into April, we see a little bit of activity here, but really in that February contract, this is what I'd be looking to put on a position here. We've talked about spreads before. If you're looking to do something as a stock replacement, you could buy yourself a little bit more time in a stock like this. Again, it's $6.41. So this is perfect for any Robinhood account. This is a speculative name. You're going to see a lot of volatility in this name. It's up 18% on the day here. But if you're looking to use a little bit of money and not tie up $6 per share, you could even look to do something in the 6 contract here, or the 5, or you could even do a spread where you could sell a 6, or you could buy the 6 and you could sell the 8, 6 strike, 8 strike, and do something like that. I mean, there's different ways to do it, but this is where following the money creates a signal in interest, and then you start to figure out what's going to be best for you to manage your risk and your account size. So that's what we have right now, and in the next video, I'm going to talk about the #1 thing to look for in 2021 in the next video. So until then, take care and good trading.